Good afternoon, folks. It's Dave Burrows, and it is July 15th, and I want to welcome you to another Barometer Weekly webcast. We're deep in the heart of summer. We've started the earnings period. We've had some earnings from some of the banks and some reactions to those. We've had more discussion of additional stimulus this week. We have had some news on a couple of potential vaccines, and there's been lots going on in the market. Not a summer to ignore things. So I just want to quickly run through sort of from the top what's happened over the course of the week and some of the things that we're focused on. Just to kick off, as we've discussed for some time now, we continue to believe that we're in a long-term secular bull market for stocks. The S&P 500 has been working its way higher for several years. We've come down and tested the uptrend several times. We dipped briefly below it during the February-March sell-off and quickly rallied back above. So long-term secular bull markets are marked by short, sharp pullbacks, which we had several in the 1980s and the 1990s. This is the 1998 Asian currency crisis. And they're quite different than secular bear markets, which have these long, steady declines, which frankly are far easier to navigate sometimes in short-term corrections. You have time, you can see deterioration, you can step aside and protect yourself. So as it sits right now, we've had fairly clear leadership in the market, and I'm gonna make it a fairly short call today, but just focus sort of on the big picture, because certainly there's been some news in the market, and it's caused some movement to take place. So on June the 24th, we highlighted the fact that our long-term breadth models had reversed down. In other words, the percent of stocks performing well had started to deteriorate. The NYSE had moved down from about 80 to about 65. So 65% of stocks in uptrends. The reason that we care about that is we want to know what the weaklings are doing, because if you're just staring at the strongest stocks, you wouldn't have any idea if there was any deterioration under the surface. We have thought for some time we'd see some bumpiness through the summer for a couple of reasons. One, the market's come a long way. Second, we're going to have increased debate around the election. And I think that it's clear that Biden is in a decent position from an election standpoint. Market might be a little bit afraid of that because clearly he might likely raise taxes or roll back some of the deregulation that's taken place under Trump. World bullish percent has been backing off, so it's not just the US. Several markets around the world have seen some narrowing. Now, this is really important because if we look at what's been going on in the broad indices themselves, they've looked pretty healthy. And there's certainly lots of things doing well. There's been very, very strong leadership. Now, we fast forward a week to where we are today. Breadth has continued to narrow, despite the fact that the market has been moving higher over the last year. As we sit today, about 50% of stocks are in uptrends in the NYSE. We're approaching that on the world bullish percent. And so what you can see is that, again, we've sort of continued to narrow, and some of our short-term indicators have. I pointed out about 3 weeks ago, 96% of stocks had upward weekly price momentum. That's upward trajectory. As we sit today, about 20% of stocks have upward price trajectory. So that has a bearing as well. Where breadth had deteriorated from 80% down to 68% as of last week, you can see that we've moved down lower, down to 50%. That means we're not putting on new positions. It means that we have fairly tight stops on a number of our stocks. It means we've taken some positions off and taken some profit just to put ourselves in a position where if there were an opportunity, we'd have some cash to work with. And in a couple of our portfolios, we've had hedges in the portfolios because if deterioration continues, it generally follows into the broad market. So this is the S&P 500. This is the decline that we saw through February and March, steepest waterfall decline in history. Very sharp reversal. The first bounce that took place, sort of a technical bounce. Second bounce took place when we started to get some stimulus and monetary and fiscal stimulus. Then we consolidated for a few weeks. We got a second round of rally when we started to see the COVID cases in the US fall with a hope of sort of a V-shaped recovery. And then since the 8th of June, the market has been marking its way sideways in a fairly broad band. Now, this is the S&P. We know that the NASDAQ has been stronger. We know that the Russell 2000, which is small and mid-cap stocks, has been weaker. We know the Dow has been weaker. But in general, around the world, we've seen this phenomena where the market has been sort of marking its way sideways. So what happened over the course of the week that is new? Well, we focused on technology along the way because it was leading heading into the decline. It held in well through the decline and has rallied really sharply since the decline. But there were some changes this week. So we talked about the fact that the top 5 stocks in the S&P 500 make up 23% of the index, and they have been on fire, and they include Amazon, they include Apple, they include the big horsemen. So earlier this week, we had a major gap higher in a lot of these stocks, and they closed below the low of the day before. So in this case, Amazon opened above 3,300 and wound up closing just above 3,000. So that's a very significant wide range. That tends to happen when you're getting to sort of a climactic rally point, and it's something that we have to watch. And since then, we've had a couple of days where it's backed off a little bit more. So the 5 strong big stocks have been masking some of the things going on under the surface, and not to say there aren't lots of great stocks and some of the key themes that we're focused in, but certainly they have been hiding a lot. If we look at Tesla, just for example, this is probably the most actively traded stock by private investors. Just as an aside, private investors have gone from being 10% of trading volume in 2019 to 25% in 2020. Clearly, staying at home with no sports to watch has caused people to decide to trade the market. Tesla opened up 3 days ago at $1,800, wound up trading all the way down to $1,500. A 20% swing in the day or a little bit more. Has had similar over the last couple of days. And then we talked about Square last week, and Square, like many others, had similar price action on that day. So these are things that we sit up and take note of, because this has been the strength in the market. We have taken some profits in a few positions. We haven't done major reallocation, but certainly, if you looked at the NASDAQ 100 across the board, you had a very big open day, closed below the low of the day before. That's called an outside reversal. It often happens at change points in markets. Certainly, we had it happen back in March in a number of positions. Now, on the other side, we've talked about some of the groups that have been lagging, the ones that we've been avoiding. They've actually had a little bit better week. Energy had a little bit of a bounce over the last 4 days after significantly underperforming. It has been underperforming in this rally. Given the fact that we have had some vaccine news and some additional stimulus news, some of the more reopening type trades have had a little bit of an impetus behind them. But I want to make it clear, from a long-term perspective, this little bounce over the last week hasn't had much impact. And relative to the S&P, we're still trading near relative lows. If I look at a point and figure chart, which we use to help us recognize changes in trend, this is the point and figure chart for the XLE, which is the energy ETF. It has been making lower lows and lower highs, lower lows and lower highs. So at this point, despite the fact that there was a pretty good rally over the last week, not something to get excited about at this point. In fact, would be an opportunity for people maybe to reduce some energy weight. Let's talk about the banks. This has been a group that has been a significant underperformer. But over the past week, it's had 2 very good days. We've had some earnings reports, JP Morgan, Bank of America, Citigroup, Wells Fargo. There have been sort of some bounces across the board. Most banks took pretty significant rate downs towards bad debt. Most of them had pretty good earnings due to the fact that trading volumes have been quite high. So the question is, how relevant is that? Again, as we see lower lows, lower highs, lower lows, lower highs, lower low, lower high. At this point, not enough to get us excited. I think probably some significant short covering. So you've seen a little bit of weakness in the strong sectors. We've seen a bounce in some of the sectors that have been underowned and unloved. Probably there is still a lot of news to follow over the next number of months to do with insolvencies that will weigh on banks. So I think that we're going to probably have a better opportunity to add them as we go along. But these have not caused us to make significant changes. Things that have continued. This gold trade continues to work. With all of the printing taking place at central banks, investors are looking for stores of value as opposed to paper assets. And gold continues to work its way higher, as does silver. The gold shares and the silver shares also acting well. We're by no means gold bulls by nature. We have weights across the portfolio of about 15%, and they continue to be quite constructive. Things that haven't seen any change. Utilities continue to underperform, hitting new relative lows over the course of the week. Nothing to do here. Telecom hitting new relative lows over the course of the week. Nothing to do here. So at the end of the day, here we are. We continue to be in a recovery phase. We're probably into a little bit of summer bumpiness. We're a little bit more cautious than we have been since the bottom in March. In March, we will watch all of the positions. We have stop losses on them. My sense is likely this little pullback in tech is more just of a reset and a consolidation, but we'll watch it very, very closely. As we sit here, I think that ultimately this is going to be a process that we're going to go through. But while we sit with deterioration in breadth at the market level in the US and globally, and some of our short-term indicators being cautious, it's just time not to do too much. So we'll continue to update as we move along. If there are any questions, certainly we can answer them. I think Pamela's on the line. With that, I'll pass it over to Pamela. Pam, are you on the other end of the line? Okay. Pam, are you there? No, apparently she's not. Okay, so we'll take the questions. We'll contact you one by one to answer them for you. If you've got any questions, please don't hesitate to reach out. We love to have a conversation with you. The team is operating very effectively. We have several meetings a day over Zoom. We'd love to see everybody in person at some point, but I guess it's not just yet. With that, thanks very much for tuning in, and we'll update as things change. Thanks very much for joining.